Hey, it's Mike Cambright from FlipNerd.com. Welcome back for another exciting VIP interview where I interview some of the most successful real estate investing experts and entrepreneurs in our industry to help you learn and grow. Today, I'm joined by Sal Buscemi, who's a managing partner of Dan Drew Partners. It's a boutique private equity firm that focuses on commercial properties between $3 and $30 million. We really haven't had a lot of guests talk about commercial property, so today is exciting. And we're going to talk today about how to think like a bank and prepare for the upcoming perfect storm to invest in commercial properties that Sal says is going to make subprime look like Sunday school. So with a hook like that, you've got to stick around and listen. Before we get started with Sal, though, let's take a moment to recognize our featured sponsors. RealtyMogul.com is an online marketplace for real estate investing, connecting borrowers and capital from accredited and institutional investors. Get a rehab loan fast and close in as little as 10 days. Rates start as low as 9%. We'd also like to thank National Real Estate Insurance Group, the nation's leading provider of insurance to the residential real estate investor market. From individual properties to large-scale investors, National Real Estate Insurance Group is ready to serve you. Please note, the views and opinions expressed by the individuals in this program do not necessarily reflect those of FlipNerd.com or any of its partners, advertisers, or affiliates. Please consult professionals before making any investment or tax decisions, as real estate investing can be risky. Hey, Sal, welcome to the show.
Hey, Mike, thanks for having me. I appreciate it.
Yeah, I'm glad to have you on. I kind of just mentioned a minute ago to you that a lot of folks, because our name is FlipNerd, they assume we don't talk about commercial or we don't talk about multifamily. Of course, we've had a number of multifamily guests on, but I'd say, the reality is we're in the real estate investing space and talk about a little bit of everything. And you're not the first person to tell me that there's a big shoe to drop with commercial real estate, so I'm excited to learn your perspective on it today.
I'm surprised you let me talk about the C word here on FlipNerd, commercial.
Yeah.
Not a lot of people allow me to talk about that, but I'm flattered.
No, I'm glad you're here. So, hey, before we get started, though, for folks that don't know you, before we start talking about the topic of the day, why don't you introduce yourself? I mean, you're an author. You've got a ton of experience on Wall Street.
Let me get into that, and it's actually pretty interesting story. I know a lot of people listening to this probably watched or listened to a lot of the Rich Dad books, and they talk about going to school and getting a good job and then all that kind of stuff.
Right.
I actually did that.
Yeah.
I went to some of the top colleges in the Northeast, got a job as an investment banker on Wall Street, and really learned commercial real estate investing from some of the best and brightest people on Wall Street.
Yeah.
At age 27, I leveraged that. We call that experience, or here's a cocktail term, intellectual capital. I leveraged what I learned in my networks to start my first $30 million fund, and we were buying a lot of non-performing notes from banks like Bear Stearns and smaller community banks. And that was in 2007 when subprime was almost about ready to hit, but not really.
Yeah.
Fast forward to today, I've been involved in some other things. I know you and I have talked about that offline, a defaulted hard money fund. We were buying a lot of these hard money funds in receivership. We have an office in Las Vegas that focuses on that. And as we've wound that down, we see another opportunity now. And this is really, truly the opportunity that you and I were laughing about, which is going to make subprime look like Sunday school. And that is the commercial defaults that are going to hit. A lot of these loans were made in 2005, 2006, all the way up until 2009. And what happened is that these loans are coming due. A lot of them have 10-year terms on them. And you have no hope of getting refinanced. There's to the tune of about $1.4 trillion, and most of them are upside down. And you're going to see a lot of this actually really paralyze a lot of lenders. It's going to force a lot more of these 8,000 banks that we have left in the United States to consolidate or to close up shop, because let's face a $10,000 check to you and I is a lot more meaningful than it is to someone like Warren Buffett. So when you have these smaller community banks, you're going to see that they're going to be looking to get rid of this stuff very quickly. And oddly enough, even if the loans are performing, a lot of these smaller lenders are under pressure from the from the FDIC to move a lot of these assets. So really what we look at is that we are what we call a debt and equity capital provider. Okay, we don't buy anything, we fund a lot of things. Mm-hmm. And our clients are two people, mostly like what you would see in residential, only it's the same thing in commercial. People who have found something interesting to buy and they don't have all the money they need. they come to us. Or what we're seeing now, about 60% of our business are people who have been asked by their banks to be their note back at a discount. We don't use the word commercial short sale, but I think that has a connotation which many of your listeners can understand that, yeah, there's going to be a lot of commercial short sales going on. Us grown-ups, though, grown-up men and women in the industry, call it a discounted payoff. So you're going to see a lot of opportunity here that a lot of people haven't seen in a generation since the old days of the RDC.
Yeah.
So I'm very excited about that. We've been very busy preparing for this.
Yeah. So why don't you talk a little bit about the banking side of that? Because I know we said we're going to think like a bank. Because I know for a fact that there's some banks that I deal with that several years back, they had loans that were performing. There wasn't a performance problem, but they had some ratios that were out of guideline with the Fed, and they were forced to call these notes, to sell them, to do whatever they had to do to get rid of them, to kind of rebalance their portfolio, even though they were performing.
Yes.
Which to guys like maybe not you, but to me and a lot of other friends of mine,
yes,
it's like, why would you care about anything other than a performing note?
Well, I mean, if you've ever read through the language of a commercial loan, they make it so that you're always at any given point in violation of the loan covenants.
Yeah.
So they can actually foreclose on that at any given time without giving you, prior notice. They can say, Mike, you're a nice guy. They'll dine you, send you Christmas cards, but before you know it, you'll be off the Christmas card list the following year, and they'll be calling the loan due.
Yeah.
Here's why I think it's important and this is where a lot of investors got wiped out. It is much easier to be a capital provider because you can make money multiple ways, rather than just owning something. And if you think about it, I've traveled throughout the United States. I've been to cities where I was born and raised in New York, where the tallest buildings in every city, even small cities such as Silverton, Colorado, they all have the name of a bank on them, not a landlord. And so you got to think about that. You have to think like a bank. And what I'm urging people to do is to get aligned and get trained so that you can actually understand what institutional capital providers like us are looking for. Because this is how real world is in times of chaos. But you also have to know how to structure these deals so that you benefit from this too as well. It is possible to have a multi-million-dollar IRA by holding what we call equity stakes, or in the industry, hope certificates. That's one of those sexy cocktail terms that us institutions use, where somebody, think about it as a rehab. You give someone money for rehab. You use our money, for example, as a rehab, and they buy a house, a junk for $20,000, they sell it for $100,000. Wouldn't you want a piece of that equity after they sell it or refinance? And that's what's happening in commercial. And commercial too is it is where the grown men and women hang out. There's no hoop or respite to protect, the homeowner or anything. There's really no political gain by protecting the fat cat type of people who are, who are the people who are facing foreclosure in commercial real estate. It just doesn't make sense.
Yeah. So
that's where the opportunities are today.
Yeah. Great. Well, tell us a little bit about, I don't want to steal your thunder. I'm already thinking, how do, there's a lot of people that listen to our show that have all sorts of, we're blessed to have a lot of people that listen to the show and watch the show. So a little bit of every sort of background. But for guys like me that have primarily invested in single family houses for a long time, and I understand that there's an opportunity coming. There's some guys like me that have been investing in single-family homes for a long time, and you love the idea of being able to apply larger amounts of capital and do larger investments. Kind of to your point of that's where the big boys hang out. Is there's a lot of drama that goes away with that. But how do you transition, or how do you kind of make your way to position yourself to this opportunity that's coming?
A lot of the people that work with us, we call intermediaries. These are people who still have a very successful residential real estate flipping, wholesaling business. In the industry, we call it crossing the trade. You're crossing trades. That is something that you never want to off, because that's paying you today.
Yeah.
But if you're in the business, you're naturally going to be finding opportunities. Just because you're in the business, somebody's going to come up by you, and you're going to see an opportunity underneath your nose. And so you need to be able to look at this. And if it's all right, I'd like to qualify this.
Yeah.
The deals. These where your listeners are going to be very competitive are going to be between what we call $3 and $30 million. This is smaller balanced commercial. If you start seeing the Empire State or the Brooklyn Bridge for sale in box, chances are you're not, that's not really a good deal. So you're looking at the smaller community type who are going to be unloading this stuff. And that is how you're going to be able to qualify whether or not that this is a real deal or not. That's where a lot of people are going to be competitive. I just want to reiterate that between $3 and $30 million.
Okay.
And I would just say, look through your inbox, see what you've got. And you also offer, if I can, how to be able to qualify these deals in 90 seconds or less. Is that okay?
Yeah, absolutely.
Okay. So let's get with this. So let's just say you're combing through your inbox and there's a commercial deal, or somebody, broker, a realtor, title agent, somebody has brought to you an opportunity and they don't know what to do with it. I don't know how to do everything in life, but I know people who are smarter than I am, and that's basically how I deliver that to my success. So if you look at it this way, the most important way that you want to do this is look at 5 data points. A lot of times brokers will send to you these huge 22 megabyte PDF attachments that are just loaded with stuff that really doesn't make it doesn't matter. It's useless.
Yeah.
And what they're trying to do is trying to confuse you to convince you to buy. And a lot of people have gotten hurt doing that. What you want to do is you want to look at 5 data points. Number 1, the current NOI. This is what the asset is throwing off today, the net operating income. And that is the driver of value for the property today. Not what it will be, not what it was 20 years ago, but what it is today.
Yep.
The second one is the pro forma NOI. And one of my colleagues on the street here, you don't have to worry about it being a lie because it is a lie. But at least it'll tell us exactly where the borrower is trying to get to. Number 3, the debt structure, the debt stack. How much debt is on here? These 5 data points are going to help us to determine how we're going to engineer a solution to this deal. So we want to know how much debt is there. And sometimes these properties, you're going to find about 50% of them are going to be over leveraged. I mean, this is not news to anybody on this call, but for some brokers and other people who are not in the know, who really aren't trained to think like an investor, this is news to them.
Right.
Number 4, I want to know what the sources and uses are. So if we provide capital to someone, what are they going to be using that money for? A lot of, we'll put in a spreadsheet, sources, Sal, uses by apartment complex. Well, that doesn't really make sense. When you move into an apartment complex, you automatically assume that there's going to be a roof and light bulbs and toilets, right? That's not value-added improvements. But what people do not expect to have are perhaps 2.5 horsepower Whirlpool tubs for mothers to relax in. That's a value added. That'll get people migrating across the street to a new apartment complex in a short period of time.
Yeah.
A newly paved parking lot, nice landscaping, perhaps a part-time foyer. That's important. So number 4 is the sources and uses. And number five, the last is the exit strategy. If we're a short-term lender, we are not someone who's going to be making 30, 40-year loans. Our max term is 3 years. We're like a private bridge hard money lender.
Okay.
So how are you and I going to be taken out of this deal with a borrower? Does he have a plan? When is he going to? And there's only 2 exit doors when there's a fire in the movie theater. It's sell or refinance. And right now, both are picking pretty high. There's a point there where banks were not lending as much as they were. So you're only with a sale. But now we got to figure out, what are they going to do? Are they going to sell, or are they going to
Yeah. Hey, Sal, so why don't you clarify, let's talk about different property classes or property types. So in terms of the opportunity that's coming, and maybe even in terms of what you guys invest in or what you advise people to focus on or stay away from, or I'm not actually sure what your criteria are, but you do multifamily, office buildings, like car washes. I mean,
groups. Yeah. Well, this is a whole different. Ask me that in a second. There's an environmental risk with that. But we like 4 food groups, and the 4 food groups are this: multifamily, retail, office, and warehouse. Let me say that again: multifamily, office, retail, and industrial warehouse. Where you're starting to see a lot of things get hot right now is multifamily. I think multifamily has been sort of overbought. I think if I was owning multifamily right now, I would be a seller of multifamily. I think the opportunities today you're going to be in a mixed-use warehouse. Companies like Amazon are buying up all sorts of warehouses throughout the country so they can improve their delivery systems and mechanisms.
Yeah.
I also see a lot of opportunity too in the part retail, not all the retail, specifically grocery anchored, pharma anchored types of Walmarts, smaller town type of stores. They call them Alcoas, Dollar General, general stores. These basic staples.
Yeah.
And then lastly, what I like, probably something that you're going to see a lot more of, is hospitality starting to come back a little bit. So that's going to be some interesting stuff. And so, most notably, the smaller type of things. As consumer spending comes back, people are going to start to go on vacation and have fun. So, the small flat, meaning a Marriott or a Residence Inn or something like that. These smaller types of hotels, I think, would be the next big thing. I think things I would advise would be like huge retail like Sears or JCPenney. I think that they're death knell right now.
Yeah.
Sears is going to be getting rid of a lot of real estate, but that's an opportunity. And office too. Office is coming under a lot of pressure because a lot of people are working from home. They're telecommuting now.
Right.
There's no need to go into a big office building to do that. And I would stay away from it too as well, because it's just some of these doctors are having a hard time making ends meet, and that could put pressure on cash flows for
and when you talk when we talk about things like warehouse, I know you mentioned Amazon's buying up space, but with a lot of warehouse space, my gut tells me you're either doing terrible or you're doing well. I mean, because you probably have one tenant usually, right? So either you've got them or you don't. I mean, is that how you look at it? Or are you looking for stuff that's currently performing only?
Well, I mean, that's a very good question. One of the things that we want to stay away from right now, which I think was overbuilt, was the proverbial self-storage. There was a lot of self-storage it was a gateway drug to people wanting to become a developer. You were a fun-loving dentist or accountant, and you wanted to take a risk. You'd invest in some land and you'd build, buy some steel and cement and build a of self-storage.
Yeah.
Overbuilt. That's a little different now. When you look at the warehouses, you look at the industrial, you have to make sure that you have a good, strong corporate tenant behind you who's going to lease this out. Recently, we wrote a term sheet for a corporate tenant that was actually putting something together, storage for a big pharmaceutical company. And this is something that was just found in the middle of nowhere in Arizona, but they wanted to make sure that they had a good temperature controlled environment for them to warehouse their drugs or whatever it is that they were doing.
Yeah.
So they have a huge 15-year commitment on something that they built, and it worked out very well. A lot of these too have been turned into data centers. That's a little more expensive to build. You have to put in cooling systems and all that type of stuff.
Sure.
But you're starting to see those things pop up too as well. The old staples. People want to get started and they want to build portfolio of cash building income. If they have the stomach for it, mobile home parks are always the way to go. If people want to buy an account, you can always buy these on terms because banks don't like lending on them.
Right.
I think family's gotten a little toppy right now. Not to say you can't find some good areas, because real estate, especially in this industry, creates both winners and losers, and it depends on what side you're on. Think about it. Somebody's running their multifamily to the ground because they live in California, thing in Texas. Story, by the way.
Yeah.
They bought it at the equivalent of a 2 cap, and what happened was because they wanted money, they fired the management company. So it used to be 97% leased. Now it's 68% leased. The Indians took over the resident, and so that's an opportunity there for buying something at a discount and turning it around.
Yeah. So Sal, let's get into the weeds a little bit and talk about how people that want to maybe pursue and get active in this space and maybe don't have deals come across their plate right now in the commercial space, is what are some of the things that they should be looking for? And I guess maybe give some context to the reality is there's probably a lot of people listening to the show that are primarily single family investors, and a lot of them are one-man bands or smaller organizations where they're probably not used to doing partnerships as much as what's common in commercial, obviously. But talk about kind of the pieces of the team that you need to put together kind of a team of people to kind of pursue commercial opportunities.
I think what you have to do is you just have to know what to look for. Number one, you have to understand what to look for and actually, beyond the shadow of a doubt, really understand if you have something that's an opportunity or not. That's number one. Number two is look underneath your nose, but ask around. Talk to people and say, hey, are you seeing any commercial foreclosures? Are you seeing any stress? Where we like to target, and maybe some people might not appreciate this, but where we like to target people who have a lot of commercial distress are usually out-of-state owners because they've bought something and they don't know how to manage it and they run it to the ground. And number two, hard money lenders, because they haven't been taken out. And I know in where you are in Texas, urban Texas, there's a lot of hard money lenders, and a lot of them are competitive. What they're doing is making loans for more than they should to get involved in these assets.
Yeah.
And what you need to do, once you understand that, you need to make sure that you have a good, strong, dedicated capital partner on your side. Now, I'm not the only guy, in town doing this stuff. There's many other people, but you need to know how to present these deals, because the whole premise of wealth creation and commercial real estate is not you knocking tin and painting doors and doing all the hard work. It's having somebody else do that, but you get a piece of the profit participation by bridging the capital, which is us, to somebody else who's a borrower or operator. Does that make sense?
Yeah.
So this way you're able to leverage your time better. You don't have to go out there and worry about drawn out short sales, all sorts of drama that comes with foreclosure and people in foreclosure. You're dealing with grown-up women and men who are professionals who really want to put deals together because they have an alignment of interest with you to make sure that these deals close, because that's how they get paid.
I see. Okay. All right. Why don't you take a minute or two and just kind of share what you think if the not multifamily, but just commercial market has a big fallout like you expect, and a lot of people do. What are the implications that will have on the rest of the economy at a high level? Single family. Talk about some of the implications.
I can get into.
Yeah.
Banks aren't lending right now. Even Ben Bernanke, our esteemed federal Fed chairman, couldn't get a loan. If commercial really does really drop the way we expect it to, banks are going to be paralyzed. They're not going to be able to lend, and they're not going to be making loans anyway. They're not making loans right now because they're licking their wounds, and they only want to work with the top borrowers to be able to do this. So you have to be qualified socially, financially. I mean, it's almost ridiculous what you have to go through in order to get a loan today.
When you say to get a loan, are you talking about for commercial deals?
No. For residential. For commercial, it's even more difficult today too, as well, because they want you to bring a lot more money to the table. Private capital providers, hedge funds like ours, are going to be the ones who are providing capital during all this chaos, and that's really what it is.
Yeah.
So if banks start getting in trouble because they have a lot of non-performing loans, they're going to stop making loans. If they're not making loans already, they're definitely not going to be making loans. And that's going to have negative implications for a lot of things, especially in an American economy where a lot of people are dependent upon using their homes as a piggy bank with the old HELOC loans and refinancing every 6 months. And
right.
I mean, there are people in California who I think didn't really work during the early 2000s. They just kept refinancing their homes over and over again.
Yeah.
And they could because they were making $500,000 every year in home equity, perceived market equity. That's where I think it is. And unfortunately, that's going to have a ripple effect for realtors and mortgage brokers and people who are connected to the finance-based society or economy where people are living off of the success of the real estate market.
Yeah.
That's what I think.
Yeah. But the great thing is as you and I both know, where there's smoke and fire, there's opportunity. And even in the residential market, I've said it a number of times, probably people may be tired of hearing it from me, but man, I'd love to have 2008, 2009 back in the residential market because we were tearing it up.
I've bet my whole career on this, Mike.
Yeah.
I mean, either that or I'm going to be working at Walmart pretty soon.
Yeah.
So, that's really what it comes down to, and you will see that. You will see that. I could get a little deeper on this. I don't think people really want me to go that deep into it, but you have to think about it though. There's been no increases in wages, right? I mean, wages have been stagnated, taxes have gone up, inflation's gone up, and people have less than 1% saving, 1% interest on savings. So it's only natural that you're going to see people gravitate towards housing. They're going to bid it up again, and then pretty soon the music will stop and everything will drop. So I think you're going to start to see a lot of pain happening. Especially now after the last election in November that happened this past November, I think you're going to start to see where banks are just going to have to start getting rid of stuff at deep, deep discounts.
Yeah.
And you better be aligned with someone who has capital in the pockets to be able to pull these deals off. A smart set of eyes, smart money, to be able to really understand how to be able to structure these deals with your best interest at heart. Because anybody can see an opportunity, but funding it is 90% of the problems.
Yeah. And Sal, so tell me about maybe can folks, so there's there's a number of banks that I work with here actually on residential stuff, but they're smaller community banks typically. You know, about how to start building relationships with those guys to let them know that if and when the time comes, I might be interested in.
Let me just give you an ad hoc script right here. It's probably perfect. And if you want to transcribe it and send it out to your family, I'm fine with that. What you want to do is you want to be able to find banks that have less than $2 billion under management, under $2 billion with a B under assets, $2 billion. And you want to be able to call the chief credit officer, or you want to call someone who's in charge of their portfolios, okay, their loan portfolios. Bigger banks have different names for them. They call them chief credit officers, whatever. Stay away from the Bank of America. Stay away from J.P. Morgan and Fargo.
Yeah.
The Federal Reserve takes care of their own. These guys don't need you. They're not going to be selling stuff from you.
Right.
Nobody really cares if you're related to Bank of America. They're not really the most esteemed institution in this country.
Right.
I will tell you that what you want to do, you want to call these folks and say, hey, my name is Mike. I'm calling from Mike Company, Investments LLC. We're based in Dallas, and I'm just wondering if you have anything on your balance sheet that you want to clear. Right then and there, they're going to say, this is very interesting. And there is an FDIC infographic I put together that shows this, and I'll share it with you, Mike, if you want to disseminate that to your group.
Yeah.
But this is something where it's a step-by-step. You don't go to the FDIC.gov because there's no search engine there. You have to go to a secret link. They make it difficult. Like any other government institution, it's never easy. It's sort of like going to DMV. But once you know what to look for, excuse me, you've hit the promised land.
Yeah.
And this is what our folks in New York do all the time, but only on a national basis. But I know you guys have relationships with people who work at banks. LinkedIn is a very powerful, very powerful resource to use. And if you combine using LinkedIn with the FDIC infographic, you're going to find that you're going to be able to get involved in a lot of relationship banks that are not only going to help you with your flipping business, wholesaling business, or short sale business, but it's going to really open up the minds. And now you're going to be able to find an opportunity in commercial and be able to bring that to capital providers like us. Is this good?
Yeah.
Is this make sense? Okay, great.
Yeah.
Okay.
Yeah.
Again, you're the Larry King, and I'm just talking here. So
well, at least I'm not
slow
Oprah.
this New
At least
Yorker
I'm not
down.
Oprah. Awesome. Well, hey Sal, I know you've got. I know you're an author, and you've got some books out, and there's one in particular that we were talking about before, "The Art of the Raise." Why don't you tell us a little bit about that and how folks? I know that you've got kind of the ability for people to get an advanced copy right now, so we'll add a link down below. But why don't you tell us about that book?
Absolutely. We put this book together. This is my second book that's going to be talking about how real estate funds are really structured. Funds are one of those cocktail terms where everybody likes to throw it around, Mike, but nobody has a clue as to what it means.
Yeah.
So we're going to be talking about how really funds like ours work. We really pull back the layers of the onion here. And the reason for that is because if you understand what your money looks for and what the needs are and how they're structured, it's going to be great. Plus, I'm going to go out on a limb and I'm going to challenge everybody who's listening to this that they should really think about their own funds at some point in their career as a real estate investor.
Yeah.
If you have a dedicated pocket of capital, you're going to be a lot more profitable. You're going to be a lot more aggressive and competitive to be able to go out there and get deals.
Absolutely.
And it's easier today than ever before. And I'm going to say something very controversial. And that is, it's easier today to raise money than it is to actually get it out the door. Can you believe that, Michael?
No doubt about it. No doubt about it.
Okay. You have, for the past 12 years, 13 years, less than 1% interest. And to this money manager, there's no catalyst for rates to increase. People are desperate for yield, and they want anything they can in order to get some sort of semblance of somebody they know who they can get on the phone and say, hey, I got some money, or hey, what are we doing with the money that I gave you? They want more intimate management of their money into someone who understands how to use real estate.
Yeah.
That's my my passion right there, is the fund management business. I love it. So there's an advanced copy that we're offering to people. And I think I sent you a link to this. It's a special link for your group. But this is going to give them in 29, 30 pages, really what they need to know. And it's going to make them actually smarter than 95% of the people in the industry.
That's awesome.
I think it's neat. So it's going to let people understand exactly what it is, how these funds work, and how they should start talking to people. Because believe it or not, if anyone's on here, I firmly believe that they've gained the notoriety at this point, just like we were talking about with you a couple of days ago before this call, is that you gain a little notoriety as a real estate investor, and guess what? People want to invest alongside you.
Sure.
And they have money. And the one thing that freaks people out is, what do I do with it? What if I lose it? Where do they write the check to? This book will take care of all of it, and it's free for your listeners.
That's great. That's great. I look forward to reading it myself. So, well, sure. Sal, hey, thanks for joining us today. Definitely appreciate your insights, and I think for those that are listening, if you haven't been through a different cycle before, it creates tremendous opportunities for sure. So don't let what Sal said here scare you. Start thinking about how to position yourself to take advantage of the opportunity, because it's going to be real. And even aside from this, there's booms and busts. So that's what real estate in America is all about, is cycles to ride out. So thanks so much, Sal, for spending your time with us today.
Thank you, Mike, for letting me talk. Thank you.
Yeah. And we'll add a link down below the video here for those that are interested in getting an advanced copy of Art of the Raise. Thanks, Sal.
Thank you, Michael.
All right. Care. Have a great day, my friend. Are you a member of FlipNerd.com, the most robust real estate investing platform in existence, where you can find off-market wholesale deals and great vendors literally in your market? You can get access to advice from experts and learn about local clubs and events right in your backyard. If not, please visit FlipNerd.com and register for a free account. You can register in less than a minute. It's pretty much the coolest site that's ever existed in the real estate investing industry, so get on over to FlipNerd.com.